Hello there, welcome back to my channel. My name is Marco and today we are looking at 2 steps to Investing for Beginners UK 2020 edition.
But Marco, everyone knows that investing is risky.
And they are bloody right. I mean, it is risky. However, did you know that you're already investing whether you want it or not? The workplace pension you are contributing towards every month is likely to be already invested in the stock market. The idea is that your contribution will grow over time and you're gonna get more money when it's your turn to retire. So, there you go, you're already investing. End of the video. No, hang on, there is way more to investing. You could invest your savings. And the first step is to pinpoint the goal you want to achieve by investing. In my case, I am investing to buy a house by January 2022. So that gives me 1.5 years to grow my savings as much as possible. Other goals you can have in mind could be, for example, to grow a pot of money to set up a business or for your kids' college, etc. It's very important that you know when you will need that money. For example, are we talking about 1, 2, 5 or 10 years? How long have you got to grow your savings? If you need that money after only 1 year, remember that investing is risky and the value of your investment might go up as well as down. And if you are unsure on anything, just give me a call and we'll talk about investing, side hustles, saving tips, all about money. Link to my phone number in the description below. And the second step is to pick between 2 strategies, active or passive investing. Let's talk about active investing first, which is when you go out and you spend time looking for company shares that are currently undervalued, which means that they are on sale between air quotes. And then after you buy your investment, you're either gonna hold it until you hit the deadline of your goal, or you're gonna hold it until you hit some sort of investment goal, let's say 50% profit. If you want to take on an active investing strategy, you need to dedicate at least a couple of hours a week to this investment strategy. I mean, some people will dedicate pretty much their whole life to this strategy, just reading company charts and company fundamentals all day and all night long. But you don't need to dedicate your whole life to find good stocks. If your goal is long and stable growth for the long term, then you should look at blue chip companies. These are your big and established companies like Johnson & Johnson, Disney, McDonald's. Again, not telling you what to buy, just giving you examples. The advantage of these big companies is that it's really hard for them to just disappear overnight. And because of that, you're probably gonna see a slow and steady growth for the long term as opposed to an explosive profit for the short term. But if you're looking for quicker growth, then you should add some growth stocks to your portfolio. Growth stocks are your small startups that don't have any profits because they're taking every dollar they have and investing it into their business. So you can think of companies like Amazon 10 years ago or Starbucks before there was a Starbucks in every town. Just remember, the bigger potential upside comes with more risk. I mean, before Amazon blew up, people thought that eBay was going to be the next big online retailer. And look at how things turned out. So you can think of active investing like looking for companies that fit your goal and give you the best deal. Passive investing, on the other hand, is quite different. And in this case, investing requires almost no upkeep from you. This is because you can potentially have just one fund or ETF that you want to invest in. And every month, you're just gonna add more money into it. So the fund and ETFs I'm talking about are basically a pre-made portfolio of companies. And instead of you going out and trying to find the best company to invest in, you could invest in an ETF like the iShares MSCI World Index, ticker symbol SSAC. And this fund includes about 1,600 companies from across the globe, which means it includes just about everything. So that means blue chip companies, growth companies, international companies, you name it. Or something else that you might have heard, like the S&P 500. This is truly a passive investing strategy because once you pick your ETF or fund you want to invest in, you just have to invest into it every month, systematically. And so, for example, you can add £1,000 to it every month, and you're not trying to time the market in this case. Whether things will be up or down, you're just gonna stick to your schedule. For your information, this is not financial advice and I'm not a financial advisor, so always do your own due diligence before investing. Anyway, one of the mind-blowing secrets to investing is that the least fees you pay to invest, the highest will be your final return. It totally makes sense if you think about it. So the best way to invest money is to go for the investment platform charging the least amount of fees. And if you live in the UK, the app charging the least, as of now, is Trading 212. I've made a video on Trading 212, which will appear above me now. It's basically a full review of the platform with all the good and bad things of the app, and also a step-by-step tutorial on how to open an account on Trading 212. But the bottom line is, you can invest as little as £1 and for as cheaply as possible in the UK. And if you use the link in the description to open a Trading 212 account, you will also get a free shares valued up to £100 when you invest at least £1. Hey, did you like these investment strategies? You will find another bunch of them when you click on this playlist of short videos that I created specifically to learn about investing from zero to hero. Which strategy will you pick between active and passive investing? Let me know in the comments below. I will answer all of them. Thank you for your attention and see you next time.